Welcome to today's Explainer. Think about the last time you sat in a brand new car. Those physical dials and buttons, they're practically gone, totally replaced by glowing interconnected screens. Today, we're diving into this fascinating shift, moving from the macro market explosion of this technology to a micro look at one key player riding that exact wave.
To structure our explainer today, we're covering the digital cockpit boom, Visteon's Q1 financial performance, their global business wins, supply chain margin headwinds, and finally, Wall Street's bullish verdict.
Section 1. The digital cockpit boom. So we really have to start wide here, just looking at the sheer size of the pie before we figure out who's actually eating it. According to a new global forecast, the automotive digital cockpit market is projected to absolutely skyrocket. We're talking a jump from an estimated $27.21 billion in 2025 to a staggering $46.26 billion by 2032. That is a compound annual growth rate of 7.9%. This isn't just some niche upgrade anymore. It's becoming the absolute standard for modern mobility.
And what's driving this massive valuation? Well, consumers are straight up demanding connected, digital first cabin interfaces. A huge catalyst here is the surge in battery electric vehicles, or BEVs. Because EV platforms have fewer mechanical restrictions, automakers can easily drop in these immersive, multi-screen interfaces that handle navigation, energy stats, and media all at once. And right now, the 5 to 10-inch display segment is totally dominating the market, simply because it hits that perfect sweet spot of affordability, adaptability, and crystal clear clarity.
Section 2. Visteon's Q1 financial performance.
All right, zooming in on the micro level, let's introduce one of the dominant players trying to capture all this growth, Visteon. As a major global supplier of cockpit electronics, they just dropped their Q1 2026 results. If you aren't familiar with them, they're a heavy hitter, partnering with massive global automakers to build digital cockpits, battery management systems, and advanced displays. And looking at their recent data, man, what we see is a company actively surfing this technological wave.
What's super interesting here is how they're performing against the broader industry. Looking at their top line, sales actually bumped up 2% year over year to $954 million. This gave them a growth over market of 3%. So what does that actually mean? It means they're outperforming the broader production environment, basically pulling ahead of the pack, even while overall industry and customer vehicle production was actually down 3% and 4% respectively. So yes, sales were up, but here's where we hit some friction in the story. Visteon's net income dropped by more than half, falling from $67 million in the same quarter last year all the way down to $31 million. Their adjusted EBITDA also dropped from $129 million to $104 million. We've got top-line growth, but bottom-line contraction. Let's dig into exactly why that's happening.
Section 3. Securing global business wins.
To understand how they plan to grow their way through these bottom-line challenges, we've got to look at what they're actively selling to automakers across the globe. Visteon's flagship offering right now is the SmartCore HPC. Think of it as the digital brain of the car. In Q1 alone, Visteon secured their third customer win for this AI-capable smart cockpit system with a premium Chinese automaker. They also locked in another SmartCore program for vehicles in India and other emerging markets. The demand for centralized computing inside the dashboard is just undeniable.
But the really crucial point here is that they aren't just signing deals, they're actively delivering. Just look at this execution. They pushed out 20 new product launches in a single quarter across 11 different customers. We are talking about massive names here. Their first ever launch with Lexus for the redesigned ES, a slick digital cluster on the Infiniti QX65, and major deliveries in India for Hyundai and Tata. They are embedding themselves in high-profile vehicle launches all over the world.
Section 4. Supply chain margin headwinds.
Now, going back to that mystery regarding their declining net income, this balancing act paints a very clear picture of the modern auto industry. Visteon is weighing a massive $1 billion in new Q1 business against some heavy margin pressures. Elevated semiconductor costs and broader supply chain constraints took a real bite out of their profits. This dynamic environment also drove an adjusted free cash flow outflow of $23 million for the quarter. Basically, they're selling more, but right now it's costing them significantly more to source the parts to build those digital systems.
Section 5. Wall Street bullish verdict. So how are financial analysts and rating agencies reacting to this tug-of-war between strong market-beating sales and heavily squeezed margins? Well, despite the Q1 headwinds we just talked about, S&P Global Ratings actually upgraded Visteon's credit rating from BB to BB+. Why? Because they noted Visteon's fundamentally improved cost structure. S&P cited their strong cost control, noting that they've mitigated direct tariff costs and reset their cost base. They expect Visteon to maintain solid mid-teens EBITDA margins going forward, even if global vehicle production volumes start to dip.
And honestly, Wall Street remains largely optimistic about their strategy too. Polling 12 analysts, we see a solid consensus buy rating. The average price target sits at $120, showing a nice implied upside. And some analysts, like the folks at Wolfe Research, have even upgraded their target as high as $135. The street basically seems to believe that the long-term tailwinds of the digital cockpit are going to outweigh the short-term semiconductor costs.
This external optimism lines up perfectly with management's own outlook. Visteon firmly reaffirmed their full-year 2026 guidance. They're expecting their upcoming barrage of product launches to completely offset any softer industry production in the second half of the year. Now, it is worth noting that this guidance assumes memory supply won't constrain customer production volumes, which, as we know, is a crucial caveat in today's unpredictable supply chain.
As the broader digital cockpit market races toward that massive $46 billion valuation, we have to ask the ultimate question. Can Visteon's aggressive innovation and execution outpace the friction of global supply chains? I mean, they have a $385 million net cash safety net, and they even felt confident enough to return $40 million to shareholders this quarter through repurchases and a newly initiated dividend. The foundation is absolutely there, but the road ahead is complex. Thanks for joining me on today's Explainer. Keep a close eye on those dashboards, because the tech inside them is completely changing the automotive market as we know it.